Of Powell's inflation talk today. Is he looking past this $100 crude price? We just got word from Jennifer that Fed officials have jumped up or have bumped up their forecast for inflation for the year. And so that could feed through into the US dollar index depending on how Powell couches his language. So that's going to be a key one as well. So bonds, Bitcoin is another one. We can not really see that much movement off of the report today. And in fact, here's the intraday. You can see hovering around 71,775. But let me just get a quick look on the sector action. We were looking at the Nasdaq and the Dow before, but let's get a picture of the sector movement, and we're seeing tech slightly move into the green, but not a whole different picture than we were seeing only a few minutes ago. Again, the big moves probably in about 26 minutes.
All right, thank you, Jared. Appreciate it. Let's talk about now EY Parthenon Chief Economist Greg Dacco, along with JP Morgan Asset Management Global Market Strategist Stephanie Aliaga. Welcome to you both. Greg, I will start with you. So Fed holds rates steady as expected. They did say the implications of Middle East developments uncertain. It looks like Governor Miran dissents in favor of a rate cut. Interestingly, it looks like Governor Waller decided not to dissent, so it looks like it's just Miran there. Maintains projections of one rate cut in 26, one in 27. What do you think?
I think generally speaking, we have a Fed that is highly uncertain about the developments around the Middle East. And this comes in an environment where there are a number of supply shocks that are affecting the U.S. economy. And this oil price shock is another layer of uncertainty for which the Fed is not well equipped to deal with. These are all supply shocks that lift inflation and hurt output growth. And so it puts the two mandates in tension. So in that type of environment, we're going to see more caution from the Fed. And I would argue that Governor Waller not dissenting is actually a sign that more and more Fed policymakers are going to want to be in that wait and see posture, seeing how the data evolve, seeing how inflation evolve, what type of pass-through you get onto the economy, and how much weaker the economy is coming out of this environment.
Stephanie, get your response to what'd you make of it?
Absolutely, I agree. I think just a few weeks ago, we were in D.C. hearing from Chris Waller at a NABE conference, and he very clearly outlined that if the February jobs report is weak, then that would argue in favor of a cut from the Fed. But now he no longer seems to view that. And that has to do with the true uncertainty that the Fed is now facing around this oil price shock. And the reason why this is more precarious than what we were talking about earlier with tariffs is the fact that in this oil price shock, none of us know how long this is going to persist. And it can have second order effects if it impacts food prices, transportation costs, inflation expectations. We don't know that yet. But given that uncertainty, it definitely does argue for a more patient and cautious Fed.
Let's talk about inflation, though, because you got the wholesale prices this morning. That was warm.
Yes.
Right? I mean, it's one data point, but it's this trend where core PCE, the Fed's preferred inflation gauge, we're at what, 3.1? I'm just curious what you made of what you saw today. And what you, as you try to game out what you think that sort of inflation trajectory could look like. Greg, what's the base case you tell clients?
Well, I think the Fed policymakers generally are going to be concerned about the risk to inflation because we are in an environment where inflation leading up to this oil price shock was already warming up. The PPI inflation at 3.5%, that's not something the Fed wants to see. That's going to feed into PC inflation in February. And then in March, you're going to get a big shock from higher gasoline prices. So we're going to see PC inflation around 3.5% in the spring. That's with a mild shock in terms of oil prices. That is why the Fed is going to be cautious. When you listen to Fed Chair Powell, you're going to be wanting to be very attentive to essentially this notion of two-sided risks to the mandate. And I was surprised not to see more in the statement in that regard, because let's not forget, in the minutes from the January Fed meeting, there was this notion of a potential two-sided statement where essentially rate hikes could be back on the table should inflation prove, unfortunately, more persistent than initially anticipated.
What's the risk, Greg, that you see that top-line inflation bleed into core and that you could actually see a hike?
Depends on the duration.
Yeah.
The magnitude is one thing, but the duration is the other thing. The longer this conflict goes on, the higher prices will be and the higher they will stay. Because once you start seeing disruptions to actual material production capacity, refining capacity, liquefaction capacity, that feeds into longer lasting higher prices, which eventually make their way onto core goods and core services via transportation costs. So the longer this lasts, the more likely you'll see a higher effect in terms of inflation, which will force the Fed to essentially remain on pause. I don't exclude the possibility of the no rate cuts this year, and potentially by the end of the year, the Fed having to consider rate hikes because it's in an environment where inflation proves persistently higher.
Now, what about Stephanie? I mean, Greg makes the good point that the Fed being in a tough spot here. the flip side of the coin, the labor market, which is weak, and I'm curious how you think our central bankers think through that.
I think that's the other big risk right now. It really has to do around growth and the pass through that this energy price shock could have ultimately to employment too. And the challenge here is we've just been in such a really peculiar state of the world where the economy has been doing really quite well. Labor productivity is elevated, yet job growth has been at essentially a standstill. And I think there was a lot of hope that this year you would see that begin to correct, that job creation would improve. But now if you have businesses still facing uncertainty on the tariff front and now uncertainty on the energy price front, that really creates a conflict for that hope that job creation is going to recover. And we did not see the Fed change the needle on 4.4% unemployment projected this year, but that's going to be a real key focus in the coming months.
On the labor market, Greg, I've heard some smart economists, they kind of frame it like this. They say, you know what the problem is with the labor market? It's the immigration policy. And if I adjust for that, they say, we're actually doing okay. What do you make of that argument?
I love when people try to adjust for things. It's absolutely true. The unemployment rate is a calculus that looks at labor demand and labor supply. Now we've had a massive negative shock from reduced immigration, which has curbed labor supply. But labor demand has come down equally at a fast pace, if not a little bit faster. We've seen the unemployment rate actually creep up from 3.5% to the low 4%. If we look out the horizon, what I am most concerned about is what this means, this lower labor demand, for income. Because income is what you and I depend on to spend. If we don't have much income growth adjusted for higher inflation because of this shock, we're going to be in an environment where people are not going to be spending as much. And that is going to create a slowdown in economic activity.
Go ahead, Stephanie.
No, I absolutely agree. And I think you were just thinking about for the markets, we've been talking about AI driving so much of this market boom, but 70% of the economy is just the consumer. And this oil price shock has a really regressive effect. The bottom 20% spend about 20% of their income on gas and utilities. And this is just going to exacerbate the K-shaped economy, which could begin to really trickle through to depressed earnings for some of those sectors most sensitive.
How do you think, Greg, about the oil price shock? Stephanie brings up a good point. Just what it means for consumers. How do you try to think through that as an economist? Is there actually a bogey you watch, like prices at the pump, they hit $4 or $4.50? I'm curious what's on your radar.
There are a few channels through which higher oil prices affect the economy. The first one is, of course, gasoline prices. There's tremendous salience in terms of these prices being visible to everyone. The other thing is the confidence channel. If you have a handle on gasoline prices that goes from 3 to 4, even if it's $3.99 to $4.01, that has a big negative effect in terms of consumer spending activity because the morale is hurt. So there are a number of channels. Financial market uncertainty is another one. We haven't seen much of a correction in terms of financial markets. That's another big risk for consumers.
At the presser, Stephanie, Powell's going to be asked, probably repeatedly, how he's thinking through what this war with Iran means for the economy. I'm curious, how do you think he's going to sort of address that? Does he sort of just lay out various scenarios? What do you think?
All of us are in the dark when it comes to the duration of this conflict. I think what Powell is likely going to do is downplay the immediate implication to core inflation because, look, oil and food prices are notoriously volatile. That's why the Fed tends to predominantly look at core inflation. Now, that core inflation risk is absolutely on the table, but that's going to be dependent on the duration of this conflict. And at that point, the Fed is data dependent. We need to wait and see until we have more data on that.
What do you think he says to that question?
I think he's going to be very cautious and want to observe the data. There are two parties, in particular Miran and Warsh, that would want more of a forward-looking Fed, that want the assumption that essentially stronger productivity growth is going to deliver disinflation, and therefore the Fed should cut rates. We're not there yet, and it would be very, very dangerous for Fed policymakers in the current environment to assume that a certain economy is going to be in place in 6 months' time, much less 1 year's time. So Fed policymakers are going to be very cautious. They're going to be watching the data. They're going to be seeing how this conflict evolves, nobody knows, and how oil prices evolve, gas prices evolve, and as a result, how the economy evolves in general. That is going to be the approach. Patience is going to be the key word, and with monetary policy close to neutral, there is no real reason why the Fed should preemptively move in any direction, lower or higher when it comes to interest rates.
All right, Greg, Stephanie, great chat. You'll both be back with us after Jerome Powell's news conference. Much more coverage of the Federal Reserve's latest rate cut. That's straight ahead. U.S. Treasuries are edging higher on that Fed decision. Let's look at the fixed income reaction. Just look at the benchmark 10-year. We're advancing here to 422. Joining me now is Joanne Bianco, Senior Investment Strategist at Bond Blocks Investment Management. Joanne, it's great to see you. So the Fed decision, it's out, Joanne. What do you make of it? What's your instant response and analysis there?
Yeah, well, it's something that we expected. We expected them to leave the policy rate unchanged today, and we're looking forward to the press conference where we think they're going to, convey a cautious tone and a wait and see approach regarding future rate cuts.
It seemed like, Joanne, from your notes, correct me if I'm wrong, but on the macro, it seems like you're suggesting you think the bigger risk here is inflation from oil. It's not a downturn. Walk me through that.
Right. It's actually really too early to determine exactly how the conflict with Iran will flow through to the U.S. economy. But we think there's more of a risk that this is inflationary. Actually, just all you're seeing with energy prices in terms of that, being either, is it going to be a temporary shock or something that bleeds into longer term implications for our economy. And in terms of it being inflationary, you would see, like higher energy prices, possibly higher food prices, certainly higher travel costs. So all of those things could increase inflation in our economy.
Yeah, and to your point, Jen, we did get wholesale prices this morning. That came in warm. There's one data point, but the trend there, curious to see how Jay Powell thinks about that. Core PCE, what he's watching at 3.1. Given your outlook there, Joanne, I'm just curious, what would be your base case for cuts in 2026?
Well, our base case is that there's not necessarily a reason for cuts this year. With the economy still pretty strong overall, and there were significant rate cuts in the past year, so we are closer to neutral in terms of a policy, and the labor markets are holding up pretty well. And the unemployment rate of 4.4% is not something to be overly alarmed about. So all of those things add up to, an environment where we don't necessarily see the reason for more cuts this year.
Sorry, they sit on their hands, Joanne, but there is some concern out there that, hey, maybe the top line inflation bleeds into the core. What's the risk you tell clients, Joanne, if they ask you of actually a rate hike?
Yeah, and I mean, that's not our base case right now. That's something we would think that would be more likely a 2027 event at the earliest.
I had an economist on the show recently, Joanne. He said, you know what? I'm not so sure, he says, Kevin Warsh gets the official green light. I'm not so sure. And I asked him, okay, let's say that's true. How do the markets respond? He says, you know what? I think the markets might respond favorably. And I'm just curious what you make of that.
I'm not really sure that how they would respond. It really depends upon what the alternative would be. And, he's a great candidate. So I think that's something that's too soon to say how the markets would respond.
Joanne, the 10-year here, it's at 4.22. Where do you think that is? What's the range near to intermediate term?
I mean, that's a big backup in rates this month. It's pretty much retraced all of the rally in the yield of February. So, we think that it seems like this type of move back up this month is already pricing in higher inflation expectations over the near term.
Let's end here, Joanne. Fixed income investors that are listening right now, they're wondering, all right, what's the best opportunity? What do you tell them?
Yeah, well, we talk to them, we have daily conversations where we talk about how fixed income investments are really designed to help investors deal with volatile market conditions like this, because the income component of fixed income cushions them from market volatility. And so we have 27 ETFs across a wide variety of exposures, and right now we're telling them to focus on intermediate treasuries in the U.S. Treasury market. We like in corporate bonds, especially as they're widening in spread, because we like the fundamental conditions that we still see in the U.S. corporate universe, both for triple Bs and high yield. And then finally, we like a short to intermediate duration approach to emerging market debt. And we think that's a good area for investors to focus on in the market weakness.
Joanne, thanks so much for your time. I appreciate it.
Thank you.
For more on the Fed's latest decisions, we're bringing in Esther George, former president and CEO of the Federal Reserve Bank of Kansas City. Esther, it's always great to see you. So the decision's out. Here's my buddy Peter Bugvar, Esther. He just ripped this note out to his clients. Here's what he says. That was a yawner of an FOMC statement, he says, on purpose. He says, in light of everything going on in the Middle East and the global ripple effects, the FOMC could not have crafted a more non-event statement that was essentially little changed with the January meeting. What do you make of that?
Yeah, I'd have to agree with Peter on that. And I think quite intentional on the part of this committee. They are at a time where the scenarios must be stretching them in both directions. And so the last thing they want to do in communicating is to unsettle the public, the markets, in terms of suggesting a particular direction for the economy. Because right now, they don't know. They're wrestling with the longer term implication of a war on inflation, slower growth, and the labor market. And those two things are going to take a little bit more clarity before they make any move with their policy rate, I think.
What about the dot plot, Esther? What'd you make of that?
So I was a little surprised in the dot plot. Again, I think remembering these are 19 individuals. This is not a committee forecast. But I think those 19 individuals have signaled here a little more optimism, a little bit brighter outlook than I would have thought, while at the same time boosting their inflation forecast and keeping growth where it was. So it is something I'll be listening for when the chairman speaks to this issue at the press conference in a few minutes, as to how that outlook on the part of the committee participants began to look as strong as it did in the face of what we're facing today.
Now, there are some folks, Esther, they have very strong opinions on the dot plot, as you well know. I don't know if you saw this. This is interesting. Claudia Sahm on X. Here's what she said. She said, ignore the summary of economic projections, the dot plot. The Fed suspended the SEP in March 2020 due to the heightened uncertainty at the start of the pandemic. They should do the same in March 2026, Claudia says. The SEP is a set of baseline forecasts. We know too little about the war in Iran for this to be a useful exercise. What do you think of that, Esther?
Well, her point's well taken. And I think you have to remember 19 individuals are submitting their own individual forecast in a time of great uncertainty. It isn't the only time that SEP has been less helpful maybe in looking to the future. There are times that the chairman leans more heavily on it in his press conference. So I think she's exactly right. Take it for what it is. It is a very uncertain time. And the committee is not looking to, I think, put a stake in how they feel about the direction of the economy. Certainly not as we're looking at the situation in the Middle East right now.
Inflation, Esther, we got wholesale prices this morning. That was warm, right? Now, that was one data point, but the trend there, I mean, core PCE, what Jay Powell's watching closely, 3.1, I think, Esther. And I'm just curious, how do you think about the trajectory of inflation in 2026?
So I think this has been an issue for some time, and one that the committee is really going to have to come to terms with. Inflation was sticky at best. It is running well over their target now for a number of years. And even in the face of them cutting rates, this is not a policy that looks restrictive to me. So I think inflation has got to be a key concern for the committee in terms of their credibility. And I think importantly, to remember the lessons that central banks have learned the hard way is long-term inflation expectations can turn quickly. And so keeping an eye on that inflation is going to be so important, not just because of the oil price shock, but I think how it feeds into an already elevated level of inflation.
Now, what about actually the other flip side of that coin, the labor market? Because you'll hear very smart people say, listen, you got to pay attention to that. It's weak, and as a central banker, you can't let that get away from you. What do you say to that argument?
Well, of course, it's part of the Fed's dual mandate, so they do have to pay careful attention to the labor market. And I think what they've been watching carefully is they've got push and pull on this labor market. They have supply issues that have shown up clearly in terms of immigration policy changes. They've got demand issues as businesses have sort of held tight on expanding their hiring. And we saw that particularly in last month's labor data. So there is no question this committee has got to keep a careful eye on what signals are coming from the labor market right now relative to the resilience of this economy.
At the presser, Esther, of course, any number of reporters, probably a few of them, are going to take different shots at getting Jay Powell to talk about, listen, how do you think the Fed is thinking through the war's impact on the economy? He's going to get asked that a lot. How do you think he's going to respond to that, Esther?
Well, I think he's going to be very circumspect, as he generally is, in trying to lay out a path. I have to believe, though, Josh, this was a committee meeting where these participants were looking carefully at several scenarios. And we hear them all the time, which is this is a brief conflict. It has some impact, but certainly modest compared to one you might imagine that is more extended and begins to hit not only just the gasoline price at the pump issue for the consumer, but begins to feed into other parts of the economy. So I suspect they've been looking carefully at under what conditions would we find the economy reacting here. I think the chairman will be careful in the presser, though, not to tip one way or the other, particularly given the statement they put out has held pretty steady over their last few meetings.
He could, Esther, I would imagine, also be asked about this legal battle between the Fed and the DOJ. You think he bites on that one?
Well, there's no doubt people are going to be asking him both about the legal battle, about where he stands relative to staying on the committee versus leaving, whether April is going to be his last meeting. And again, having watched Jay Powell in these settings, I think he will not tip his hand until he's decided that he wants to make an announcement.
Let's say, Esther, you were in that room. I'm just curious what questions you would ask, how would you frame those questions?
Well, I think the very important questions for this committee are how confident they are in their credibility around inflation and inflation expectations. I think they need to reassure, again, in a time of uncertainty, that in the event the economy weakens, they don't have to wait for the next meeting. If something comes along that really unseats the economy, that we can see more weakness flowing into the economy, they're prepared to act. So I think just asking for his thoughts.
Esther,
on that.
thank you. We're going to go right to Jay Powell here, Fed Chair, taking the podium. Let's listen in.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do, but essentially it is that the forecast is that we will be making progress on inflation, not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that, and the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick.
Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis, and we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued. What we want to see for this year, rather, is continued progress on housing services. Finally seeing that the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see, but it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So. We look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa. Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. with what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to just remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to move they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber. Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year.
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian. Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly, but people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, the maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to
So I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see. Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
That was Federal Reserve Chair Jerome Powell wrapping up his news conference there. Stocks at session lows here following the presser. Let's send it over to Jared Blickery with the market reaction. Jared.
Yes, a bit of a bearish reaction there. We didn't really get much of any jump off of the 2 p.m. release, but as is usually the case when Powell starts talking, that's when you see the movement. Here behind we have the Dow Jones Industrial Average now off about 650 points. It was down about 400 before we got all the announcements at 2 p.m., so 1.4% to the downside. Nasdaq Composite off a little bit less, and then the S&P 500 just over 1% there, but that drop to session lows there kind of standing out like a sore thumb. The other thing I was looking at here is in the bond market. We saw a reversal of yields from earlier in the day. So here's a 10-year T-note yield. It is now up 6 basis points to 4.26%. Here's the 30-year yield. That is up 3 basis points to 4.88%. And so this isn't a huge movement given what we've seen over the last few weeks, but it's kind of going in the wrong direction. And when the 30-year gets up to 5%, that's when we've seen stocks roll over, at least short term. U.S. dollar index, this is another huge one. I was looking for a move above 100 as a sign of tightening financial conditions. That is now here. So the dollar pain trade could be on, and that could be contributing to some of this weakness that we're seeing in equities. Also want to note what's going on in gold. Gold already cracked 5,000 earlier in the day. When we started at about 2 p.m. here, it was just off of the lows, but it's sunk down. It's retesting these lows. 48.65 per ounce. And finally, let's take a look at crude oil futures. This is not a market you expect to move off of the Fed, but it's a huge factor. We were talking about, or we were hearing about those oil prices and the pass-through in terms of inflation several times over that press conference. So crude oil futures up 1% on the day to 96.66. That's WTI crude. And now just getting a quick look at the sector action. Energy, still the only green one. We had, I think we had one more green sector before, but to the downside, staples accelerating the loss down 2% now. Consumer discretionary and also healthcare, materials, communication services, real estate, all of those off more than 1%. And if you take a look at the Nasdaq 100, an even redder picture than we were looking at just about 1 hour and 20 minutes ago when that report first dropped. So not a lot of green squares or rectangles in there. And also pretty similar situation in the Dow, where we have Chevron and JP Morgan up in the green, but for the most part, just a kind of a sea of red there, Josh.
All right, thank you, Jared. Yahoo Finance's Brooke DePalma standing by with the breakdown of the Fed's new summary of economic projections. Brooke.
That's right, Josh. The Fed holds rates steady. This dot plot, which charts the policymakers' projections, indicates at least 1/4 point cut in 2026. And that would take the benchmark rate down to a range of 3.25% to 3.5% by the end of this year. Let's take a closer look, though, at this dot plot, because in 2027, policymakers do expect 2 rate cuts now, where projections remain unchanged over the course. And if you take a look, the consensus of 2026 is 1 rate cut. 2027, we'll expect 2 rate cuts and a new projection for 2028 as we make our way towards that 3% as well. But there was some indications that there was a lot of uncertainty swirling around the summary of economic projections, especially when you take a look at what we saw with unemployment that did remain unchanged. We saw the summary of economic projections for when it comes to unemployment remain at 4.4%. That was in line with what they had previously projected in December, showing that they don't expect that we will see a weaker labor market ahead, and that largely will continue to see a strong labor market persist into this year. That remains unchanged, but still up about 0.2% from their longer run target. Also keep in mind here that Fed Chair Jerome Powell was asked about stagflation, and he said we're not seeing unemployment like we saw back in 1970s. And so he said use that word for a case like then, but we're not quite there yet. But when you take a look at what they forecasted for inflation for 2026, we did see a slight tick higher. When it came to PCE inflation, that forecast rose from about 2.4% back in December to 2.7%. And largely what Fed Chair Jerome Powell right now is talking about is that increase in oil prices and the flow that will have into the economy and the inflation that we could see moving along. Also for 2027, they do expect inflation to come in just a tick higher as well at 2.2%. And also how this will flow into core PCE as well. They rose that projection as well, now forecasted to rise to 2.7%, up from 2.5% back in December, really trying to understand how exactly the impact of these higher energy prices will flow through the rest of the economy. Still lots of unknowns here, but definitely seeing a bit higher when it came to their inflation projections.
You know, Brooke, heading into this one, there were some notable economists who were saying, they were not going to put too much weight on this dot plot. There was just too many big questions. They don't know when this war is over. They don't know when the oil disruption is over. Too much uncertainty. What do you make of that?
Right. Well, Claudia Zahm, an economist, she was one to go out on X and certainly say this in her tweet. She largely said that she said that they should not publish it ahead of this report because this is sort of baseline forecast and they can't really understand fully the impact of this war in Iran will have. Now, Fed Chair Jerome Powell somewhat joked about this within the press conference. He said if we were going to skip any SEP, this one would be it because there's still so many uncertainties. He said with 19 board members, there's 19 submissions, there's 19 different answers. And so if they were going to skip anyone, this would be it. But of course, they did move forward and they did publish it, Josh.
All right. Thank you, Brooke. Well, for more on the Fed after Chair Powell's remarks, let's welcome back in now EY Parthenon's Greg Dacco and JP Morgan Asset Management's Stephanie Aliaga. Welcome back both. Greg, I'll start with you. So some highlights from the presser for me. First question right out of the gate. Should the Fed look through an energy price hike? Powell was kind of cautious there. The question of looking through when it does arise will be one to approach not likely, he said. He talked about how progress on inflation should come towards the middle of the year. If progress doesn't come, he suggests you won't see a rate cut. Emphasized nobody really knows the full economic impact of kind of higher energy prices on inflation. Actually joked about skipping the dot plot, just given all the the uncertainty. But what were the highlights for you? What did you make of it?
I have this image of Mel Gibson in Braveheart when he's saying, hold, 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 waiting to react. And I think this is very much the situation we're in right now, because he argued that monetary policy is modestly neutral, that the Fed is well positioned in that stance, not to preemptively move in any direction. And he reiterated a countless number of times, we don't know. We don't know how this Middle East conflict will evolve. We don't know what the implications will be in terms of magnitude and duration of price shocks. And this is coming on the back of a series of other price shocks, including the tariff shocks that is still filtering through to the economy.
Were you surprised, Greg, how much tariffs were mentioned in this presser? I mean, people were calling that, it was notable.
It was notable. Why? Because we still have core inflation that is above the 2% target. It's as simple as that when it comes to the Fed reaction function. They want to get core inflation back to 2%. It's not there yet, so they're still feeding off of the prior supply shock that we had a year ago, and now you have another supply shock. So I think what markets are reacting to is this notion that the Fed is going to be on hold for a prolonged period of time. Look at the dot plot dispersion in 27. I'm not talking about 26 here. I'm talking about 27. You have 150 basis points of dispersion, with some expecting actually a rate hike next year and some expecting 150 basis points of rate cuts. So a large dispersion there.
Stephanie, let me get your take on the presser, and then what do you make of the market reactions?
I think that what the Fed is doing right now is standing up straight in the face of another real credible threat to inflation. They talk a lot about tariffs because that was the first shock that they were looking at. And what matters the most about these energy price shocks is really the environment in which they happen in. And the fact that this is coming on, layering on top of already a bubbling inflation problem, means that the Fed knows it's been 5 years since that inflation rate has been at their 2% target, and they are going to be very sensitive to that. Now, they didn't necessarily downplay the labor market risks, but they did reflect that, look, we're treading water, and we don't know if this treading water is just because this is our baseline and we can do this for quite some time, particularly given the fact that the economy seems to be doing quite well. Productivity just printed at a rate that is almost triple what the decade average was before the pandemic. We're in a whole new world of productivity, and this is all before AI. So that can give you some ease around it'd be highly unusual in that environment for unemployment to all of the sudden spike higher. So right now, the risk might honestly lean more to the inflation side.
All right, let's bring in here our very own Jennifer Schonberger with her takeaways. Jen, you were in that room, my friend. What did you think? What were your big takeaways?
Yeah, I think there are 3 words we can use to sum this up, Josh. Wait and see. Chair Powell basically saying that, look, it's just too early to know the scope with which the war in Iran is going to impact the U.S. economy. And he said also, basically, don't put too much stock in that SEP. And he said there were a lot of officials who commented, look, if there were ever a time to throw out the SEP and not use it, today would have been the day. Of course, he was questioned on the fact that they have raised their outlook for inflation, not just on a headline basis, but on a core basis, and still see 1 cut this year. So how can that be? And Powell said, well, look, if you look at the dots, they have meaningfully become hawkish from what they were in December. There are fewer cuts that have been penciled in. And take a listen to what he had to say on that.
The forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
It was also interesting that a big portion of why the Fed expects inflation to come down, even though they have raised their outlook for inflation for the end of the year, is because of tariffs. And that's interesting because we know that the president has reissued a 10% global tariff in the aftermath of the Supreme Court having struck down the use of his emergency powers to issue tariffs. And we know that there are pending investigations right now under Section 301 301, where we expect new tariffs to be issued, and we expect further investigations on that front. So if you have rolling new tariffs coming out and the prospect that they replace or eclipse higher, you have to wonder what that means for the Fed's inflation forecast. And of course, this coming on top of the oil shock that we're experiencing from Iran. And then lastly, Josh, I just want to point out, he did talk about sort of the forthcoming steps that if Kevin Warsh is not confirmed in time, he will remain on as sort of the pro tempore chair because that is what the law calls for. Take a listen.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality.
Notice Chair Powell also said, Josh, that his decision of whether he stays on the board after that investigation is wrapped up hinges on what the future of the institution looks like. So you got to wonder if he is going to remain on the board, if he's concerned about central bank independence.
Jen, I'm curious how you think Trump might respond to this. I mean, you would assume response is coming because Powell was kind of delivering a 1-2 punch there, right? I mean, he's saying if the DOJ wants a fight, let's go. And two, he's saying those rate cuts you want, I'm in wait and see mode. And I'm just curious, how do you think the president might respond here?
Yeah, I mean, he's certainly not going to like the fact that the Fed is holding steady. I mean, just earlier this week ahead of this meeting, he called him again too late, Powell. He said if third graders should know to cut rates at this point. The fact that Powell is digging in further and really placing his stake in his claim certainly escalates the collision course, if you will, of what we've seen between this current Fed and the president and the Oval Office. It's going to be interesting to see how things play out if and when Kevin Warsh is in place and he is not doing what the president wants. Expect some angry tweets, perhaps, later this year on that front.
Greg, back to you. So let me ask you this kind of broader question. You got the presser, the statement, you've listened to Jay Powell. What's your base case for the U.S. economy in 2026? When clients ask you right now, given all the uncertainties, the headlines, what are you telling them?
Well, we're telling them to be cautious because it's a highly uncertain environment where the economic paradigm has shifted to the supply side. It's no longer a demand-driven economy, it's a supply-driven economy. And in a supply-driven economy, you get counter-cyclical forces, higher output and lower inflation when you get a positive supply shock, like Stephanie was talking about on the AI front, lifting productivity growth, but negative output growth and higher inflation when you get negative supply shocks. Oil price shocks, geopolitical tensions, the tariffs, all of those factors are influencing how the economy is evolving. And so from our clients' perspective, we're seeing a lot of hesitation when it comes to investment, when it comes to hiring. This all feeds together in terms of how the economy is behaving. And unfortunately, this leads to less investment, less hiring when you have this great uncertainty as to how these supply shocks are going to filter through.
Can I ask you how you're thinking about the great AI trading trend, its impact on the economy?
I'm very optimistic about AI. I think there is a strong prospect for stronger growth from AI and stronger productivity growth at that. What we're seeing right now is really CapEx investment. CapEx investment, infrastructure investment, OPEX investment, all feeding into stronger economic activity. But the productivity growth that Stephanie was referring to in terms of having this trend in terms of productivity growth being higher than the long-term trend right now is not related to AI. It's related to businesses that were trying to do more with less in a high-cost, high-interest rate environment for the past 2.5 years. That's going to be fed into this AI wave, which will sustain stronger productivity growth. So I'm quite encouraged. What I am not so encouraged by is the fact that we have seen upward movements in growth projections in the SEP. So I wouldn't necessarily say this is a time for no SEP. This is a time to rip it up in half, discard the short-term prospects because I think they're misguided, and focus more on the long-term prospects, which is where AI may actually feed.
Stephen, let me get your take on these markets because you're looking at popular averages. They're throwing a bit of a tantrum right now. Got the Dow down about 700. Your broad gauge and the Nasdaq are both down more than 1%. I mean, listen, there's a lot of viewers. People have different cash coverage, time horizons. But broadly, what are you advising investors right now?
Yeah, I think markets this week have been trying to look to the positive, look behind this
has been
oil
the theme,
price.
right? How many strategies, how resilient the markets have been,
yes,
right?
and look, history has shown us that historically these oil price shocks, these geopolitical shocks have been short-lived in nature. Markets have, operate in a world of long summers and short winters. We want to keep the eye moving forward when it comes to our portfolio construction. We still think that all of that is in place, but environments like this is why investors should have some diversification in their portfolios. You want things that are going to help shield these different shocks wherever they may come. But I think it's also really important to not completely jump ship and disregard a lot of the structural themes that are still in place and that should still drive returns over the long term. And that is where this AI theme in the US, but also globally, still remains quite intact and more resilient than the more cyclical parts of the economy in this scenario.
Morgan Stanley and Mike Wilson's team, they put out a note this week, Stephanie, and they kind of framed it like this. They said to clients, well, we expect near-term volatility, but they said they were still constructive 6, 12 months out. And in large part because fundamentals looked intact. They talked about earnings acceleration continuing. Broadly, does that sort of dovetail with your view?
Absolutely. I mean, markets are still expecting for the S&P to show 15% earnings growth this year. And the fact that the other 493 are expected to see 11%, this gap in earnings growth, it was no longer this monopoly of just the Mag 7, but you actually have other areas of the markets performing. And that's also really great news for investors trying to diversify, because the fact that this capital is being spent on hard infrastructure, on energy and power that operate in different wrappers and portfolios, they have contracted cash flows, they're more defensive in nature. That's all good news. And we think that this structural demand story is still quite intact.
I'll end here with you, Greg. Just, we can have this sort of like very almost academic conversation, but there can be a lot of folks listening and they may not even be investors. And I'm curious, Greg, if you were sort of framing this today, what you saw and heard from the Fed today, what does it just mean for everyday Americans if they asked you?
I think we're all investors in the sense that most of us have a retirement account. And so the market developments do affect us, even if indirectly, via this confidence channel of being more or less wealthy. So when you're talking about how the average American would consider this press conference, I think one thing is going to be true, that we're going to be in an environment where interest rates are going to be persistently higher than they've been in the past. 2, we're unfortunately going to see an inflation pass-through, and that will force Fed policymakers to be more cautious. And 3, we're going to be in an environment where there's going to be pressure, unfortunately, on real disposable income for many families across the country, which will lead them to be more cautious. Yes, we still have underlying resilience. We're not heading into a recession tomorrow, but we should grow accustomed to an environment where there is slower growth momentum, especially when you look at volume terms versus value terms.
Greg, Stephanie, that was a great chat. Thank you both so much. Perfect.
Thank you.
Stay tuned. We're checking in on the latest moves in the energy market that's coming up next. Donald Trump is still trying to unblock maritime traffic along the Strait of Hormuz. Today, the president waived a long-standing shipping law that requires that the transport of goods between U.S. ports must be conducted by American vessels. The 60-day waiver aims to soothe volatility in the energy market. Still, successful passages along the strait remains stubbornly low. Yahoo Finance's Ben Werschel and Jake Connolly have been following all the angles of this story. Ben, my friend, we'll start with you because you got a great story out, a new one where you're looking at the traffic, the drop in traffic through the Strait of Hormuz. So I guess, Ben, start there. Like, what is the data telling us, and to what extent, Ben, does it align or not align with what we're hearing from the White House?
Absolutely, yeah. So this data is from the IMF. It's called Port Watch, and what they do is they're one of the many trackers of traffic through the Strait of Hormuz, and they offered an update through the 15th of March, so basically the first 15 days of the war. And what it showed is just how low the traffic has been consistently throughout it. We haven't seen a single day with double-digit ship passages through the Strait of Hormuz, according to this data. This comes after it was about 95 a day in the month of February. So it shows how sharp this drop-off is and how consistently low it is, never getting to double digits. It also shows how Iran really does exercise a veto power here, and the ships that are getting through are clearly with Iran's permission. Iran said that they're going to allow energy transports to India to pass through, and that's happened. We even have pictures of a tanker arriving in India after passing through the Strait of Hormuz in one of these ships. But the overall numbers here are sort of a remarkably consistent and low data getting through, even as the Trump administration is trying all these different measures, insurance, naval escorts, at least talking about these, as well as the ongoing war to decimate Iran's missile and drone capabilities. It just shows shippers are holding back. They're scared off, and even up till recent days, this number is not budging, at least for now.
Jake, how much of global oil supply is being disrupted?
So you see usually about 15 million barrels per day of crude go through that strait, 20 million barrels per day of petroleum products, but about 14 to 15 of that is crude oil. Now, the East-West pipeline across Saudi Arabia can take up to 7 million of that. It's not taking that right now. They're trying to get it there. But the point is, you've still got several million barrels per day of crude oil disrupted that's going to get blocked off because Iran is not letting really anything except its own oil and some other single shipments from India through that strait. Most of that Iranian oil is going to China, so it's not really going to impact the global market. You still see just a huge impact from that strait getting cut off.
Ben, what would it take to normalize traffic in the Strait of Hormuz? Like, is it military escorts? Is it boots on the ground? What do you think?
I mean, I think that's one of the sort of the million-dollar question here about this conflict. I think there's an increasing sense here that it requires some sort of ceasefire between the U.S. and Iran. That's I think the outcome that the Trump administration has been trying to avoid. That they have to get to a ceasefire here. But Iran's capabilities here and their sort of consistency at this. Maybe they're not able to hold up this effective blockade for much longer, but they have shown an ability to do it so far. So I think we're kind of getting to the point where the Trump administration is going to have to figure out one way or another beyond just sort of saying we've decimated Iran's military, it's over, we can win here. We've seen some new messaging from Trump on that just today, saying, floating the idea of like maybe we just wash our hands of the Strait of Hormuz. That's a lot easier said than done because a lot of goods come through. They're not just energy, but goods that end up in the United States. So it's going to be I think there's very few experts that see sort of a quick end of this short of the end of hostilities.
That was interesting, Ben. I'm glad you brought that up because Trump did post about this on social media. I mean, clearly very frustrated with our allies who don't want to send naval support there to the Strait of Hormuz, kind of saying maybe the U.S. just abandons it, implying we're sort of a net energy exporter anyway, that we'd be fine. Hey, this is Europe's issue.
Yeah, absolutely. So his message there was that what happens, he kind of posited it on a True Social post, wondering what happens if his military, in his words, finishes off the Iranian regime, then they kind of let the countries that in his view are responsible or dependent on the Strait of Hormuz handle it themselves. Again, that's a lot trickier to do. There's a lot of goods that do come to the U.S. through the Strait. I point to things like helium, which is important for semiconductors, fertilizer, which is important for farmers, but even global energy, global prices, we've felt those effects there overall. One sort of interesting tweet I saw online today counted 7 different responses to Trump and sort of how he's going to talk, how he's going to approach the Strait, from we need foreign help, we don't need foreign help, maybe we'll leave it alone, all these different approaches. It kind of gets at the sort of overall scattershot approach we've seen from the administration here about how they're going to deal with this trade issue that is, I think, proven much harder than they anticipated.
Jake, in terms of policy responses, Trump did suspend the Jones Act, 60-day waiver. What kind of impact do we think that has on oil prices?
So it's probably not going to have much of an impact from all the analysts I speak to. What the Jones Act does, it requires that shipping between U.S. locations has to be on ships that are U.S. built, U.S. owned, U.S. flagged, U.S. crude. All of that makes it more expensive. What this could do is take a little bit of price pressure off oil and gasoline and diesel, really refined products moving from, say, the refineries along the Gulf Coast up to the East Coast that are cut off from that oil system. However, this is a global pricing issue. There's really not going to be much done from waiving the Jones Act. You see a lot of people calling for it to be abolished straight out. Trump has not done that. But even so, all the analysts I talk to say this really is not going to have much of an effect and is looking more symbolic than really material in terms of the gasoline prices, especially that the U.S. Americans are paying at the pump, and also global crude.
By the way, another headline today, you saw this, Jake. The Israelis hit this natural gas processing facility in southwestern Iran. Axios did report that strike was coordinated with and approved by the Trump administration. What did you make of that?
So this is a big escalation. That strike was on the South Pars gas field in Iran. It's part of the biggest natural gas field in the world. That is a very, very big escalation because up until now, the U.S. and Israel had really refrained from striking Iranian energy infrastructure. You saw a few strikes last weekend on fuel depots in Tehran by Israel, but up until now, the U.S. has largely kept Iranian energy infrastructure off the target list. This is a massive hit to Iran. Iran came out right away and said, here are a list of targets in the Gulf, energy infrastructure, that we could now hit now in retaliation. You then saw Tehran order evacuations from those sites in other countries, saying if you don't want to die, essentially, you need to clear out of these facilities because they're going to be hit in the coming hours. Throughout this entire conflict, the question of energy infrastructure has kind of been a red line because it's so disruptive on top of what is already an energy crisis. Remember, if this war were to end tomorrow, the long tail is still long. This is months to years to repair damage that's already been done. This is just one more step forward in escalation that's only going to back Iran more into a corner. And so the question I've been hearing is, what is the U.S. and Israeli goal here? Is this a war of attrition, trying to wear Iran down? Is this symbolic to say we can do what we want? Where this goes, hard to say, but this is a significant escalatory step by the U.S. and Israel.
All right, Jake, Ben, great discussion, guys. Thank you both. Coming up, SailPoint CEO joins us live to talk about the company's latest earnings report. That's coming up next. So SailPoint shares seeing their biggest intraday drop on record today. The identity security platform's full-year revenue forecast fallen below the street's expectations. Still, analysts say its disappointing outlook is on the conservative side and healthy growth will continue. SailPoint founder and CEO Mark McClain joining me now to discuss. Mark, it is good to see you. Maybe just start on that print, Mark. What you're seeing in the quarter, what are you seeing in the business?
Look, we feel very happy with where this business is and where it's going. I think we're in an interesting time, as you know, Josh, in the markets where there's a lot of noise out there, I guess, around software and AI, and are you a beneficiary, or are you going to be damaged, et cetera, et cetera. I think, up through what we just reported, a very strong full year, 28% ARR growth. Within that, we're a mostly dominant SaaS business. SaaS grew 38% ARR. We expanded margins by a few points. It was just a very good year as far as we're concerned. As we look forward at how to set up this year, there was a consensus that was a little strong, we thought, out there, and we wanted to make sure we set up in the right place to start, and then hopefully continue to prove our ability to raise those expectations throughout the year based on what we're seeing. The unknown, the slight unknown I think we had to account for is, and there's so much conversation about this today, are you a beneficiary or not of AI if you're in the software business? We're in a space called identity security, which is kind of keeping track of all the access and data that happens in an enterprise, what's employees and even non-employees like partners and contractors, and now increasingly non-human identities, right? Agents and bots and things like that. Well, we see the AI tailwind of a bunch of these agents are going to get deployed in the enterprise customers we serve, and they're going to need help securing and managing those agents. That's the tailwind, but we haven't seen a lot of that show up in revenue yet because customers are just getting to that point. So we're in this for the long game. We believe this business is very healthy and has lots of continued potential in front of it, but we're experiencing a little bit of noise in the market today, which is something you sometimes have to do when you're in the public markets.
On that guide, Mark, I did see analysts saying the 2027 guidance, they say, did come in below expectations. They say across the board, except EPS, that was in line. And I just wonder, Mark, do you think maybe there were puts and takes that the street didn't fully appreciate, whether it was mix or demand or a sales cycle? I did see at least two analysts, Mark, telling their clients, listen, they said, Mark's just being conservative here, but I'm curious to get your take.
Well, we're certainly in an interesting environment, Josh, and you're looking across the landscape like we are. I think part of what you're seeing is you're not necessarily getting rewarded for doing well in today's market. You're certainly getting punished for not living up to expectations. So part of this it was our first chance to set an expectation for the fiscal 27, which our case is, January to January. And we wanted to set it for a good, solid number. We of course guide to something we think we can do better on, because there's the whole experience of beating and raising expectations as you go through the year that the market expects, and we did that quite well last year. We added about 500 basis points to our final results versus what we guided to when we first came public last year. So in this case, we thought we're kind of in a condition where there's some unknowns. We feel very good about the signals we're getting. I call them the qualitative signals we're getting around our potential to be a beneficiary of customers adopting AI and needing identity security to help them secure and manage all these AI agents. But we also felt like it wasn't necessarily prudent to build all that into an aggressive guide perspective. So better in our mind to be conservative, to set ourselves up for a good, solid performance, and hopefully an even better than solid performance as we go through the year. And that's the way we decided to structure it. And we knew the market would sometimes react to that a little, but we're in a position where we think we're doing this for the long haul. We're in this business to deliver a great solution over time to our customers. And as we continue to prove that we can do that, like we did last year, I think the market will be fine.
Mark, let me ask you a broader question. We talk so much about AI and agentic, and I'm just curious where you think broadly, Mark, your customers are on that sort of AI agentic journey. Like, are they figuring this out? Are they implementing it, Mark? Like, are enterprises generally, Mark, in your opinion, are they ready for this?
Are they ready? Yes, in the sense that they want to move forward. And I'd say, Josh, it's also important to remember there's a couple of flavors under the covers here, and agentic particularly, all kinds of things happening in AI, right? But even this idea of these AI agents that folks are probably hearing about, maybe not always know what that means. Basically, it's a piece of the technology that's going to go take action on behalf of some human ultimately, right? They're doing things that a human would have otherwise done to try to get work done in business. Well, there's got to be a couple of different flavors of these things, right? One is there's going to be the agents that are delivered through the big software vendors, ServiceNow, Salesforce, Workday, et cetera. And customers, I think, are going to be reasonably aggressive about adopting that agentic capability within those well-known platforms because they probably trust that those folks have put the right guardrails in place, security, et cetera. Then the mid to large customers, which is where we focus, not say down market, small, medium business. Well, those customers have their own internal IT development shops, and they're also doing a lot of work for what we call bespoke agents, right? Things that are more unique to their business. And I think that's where there's sort of a mixed bag of people moving. What we would have said last year was the year of pilot. This year is the year of adoption. It's sort of the rate and pace of that adoption that's very difficult to predict. These customers are telling us they're moving forward, but it's not exactly clear the pace at which they're going to do that. So we're trying to set up, again, in our guide, for instance, a little conservatively, while we feel qualitatively tremendous tailwind of interest and conversation happening with customers.
Mark, so good to have you on the show today. Appreciate your time. Thank you.
Thank you, Josh. Appreciate it.
Stay tuned. We have all the action following the closing bell. It's come up next. Stocks closing the day lower here after the Fed's March meeting. Our very own Jared Blickery has the latest. Jared.
Thank you, Josh. It is a risk-off reaction to the Fed announcement, to the presser, and we were red before we came into these events at 2 and 2:30. So let's take a look at the tape on the Dow Jones Industrial Average, which is down 768 points, or 1.64%. And here's what happened after that 2 p.m. report was released. Kind of floundered around, but steadily sold off through that presser, and then even after it finished into the close. So ending the day pretty much at the lows of the day. That's not something you want to see. Nasdaq Composite off a little bit less than the Dow, down 1.5%, and the S&P 500 now down to 1.36% on the day. And I want to show you a 6-month chart of the S&P 500 because we have now hit the lowest level since late November, so nearly a 4-month low. And you take a look at the 1-year chart, we are quickly getting to the bottom, 6,600 of this extended targeted range. We already broke 6,800 a couple weeks ago. That was a big one. 6,600 is the next one. So I want to show you a few more things that happened today during the presser. This is the 10-year T-note yield. It rose 6 basis points, so kind of going in the wrong direction there to up to 4.26%. Here's the 30-year, not up quite as much, only 3 basis points, but still edging closer to 5%, that big psychological level that can cause problems for stocks. It's now at 4.88%. And then finally, the U.S. dollar index, and this is a pretty big one. I was watching 100 as kind of a make or break, and it is now above that. So that basically means that financial conditions are tightening, that along with higher long-term yields, and that puts a further squeeze on risk markets like equities, Bitcoin, commodities, what have you. So let's get into some of the sector action, and it looks like it's red across the board here. Energy snapping a 5-day win streak, but it was only down the least. What was down the most is consumer staples, down 2.43%. After that, consumer discretionary, so both of those consumer stocks. Then you got materials also finishing the day down 2%, and a bunch of others that were down 1%. But let's get to the Nasdaq 100. That is a pretty bearish picture. Not too much dark red, but there is a prevalence of red, as you can see. Amazon is a standout, down 2.5%. Tesla down 1.5%. Walmart down 2.5%. And if I show you inside the software industry, you can see SAP, Shopify, Adobe, all down more than 3%. Not a lot of green squares there. A little bit more green on the semiconductors board, but still not a lot to get excited about. SanDisk up 4.5%, Lumentum up 7%, and Intel up 2%. Let's switch over to the Dow quickly, and there we see a lot more red. Chevron and JP Morgan, the only two stocks in the green. Down 3% or more. We got Nike, McDonald's, Home Depot, Procter & Gamble, and Visa. So pretty negative tape there. And one of my canaries, the Dow Transports, the companies that ship the stuff as opposed to the industrials that make the stuff. A few green spots here, but again, a mostly bearish picture. So all in all, not the best reaction that investors wanted to see with respect to that Fed announcement today.
All right, thank you, Jared. Well, a major leadership shift at Disney is officially underway. Josh D'Amaro takes over as CEO, ushering a new chapter for the company. For more, we want to bring in now Joseph Bonner, Senior Securities Analyst at Argus Research. Joe, it's good to see you. So maybe start off just kind of the big picture with Josh D'Amaro. What do you think, Joe? Was he the right guy for this job? Would he have been your pick?
Well, he came out of the Parks Division, which is the right division to pick someone from. The Parks Division is a driver of revenue and profit, big driver. So, yeah, he's probably the right guy.
How strong is the team around him, Joe?
Well, he's got Dana Walden coming in as the creative, the chief creative officer. So yeah, she's strong, and that's really a key position since he may not have the studio relationships that you really need for this business.
In terms of some big moves, I've seen some of your colleagues on the street talking about, Joe, some moves that they think Mr. D'Amaro could consider. One is they say, listen, time to exit linear TV. Get out. What do you make of that?
That is the biggest decision he's got to make, really. A year ago, I would have said, okay, the general entertainment cable channels, broadcast channels, spin those out. And, that's where we were. So bring it up to now. Comcast spun their cable channels out. That didn't really go so well. P-Sky, Paramount Skydance, they're going to hold on to their cable channels. So, he's got to make a decision there. Either spin them out. I mean, you have a declining asset here, which, would argue to spin it out. He's either spin it out or justify why he would keep it.
Rich Greenfield, analyst, Rich, Joe, he had some advice. Here's what he told clients this morning. He would like to see D'Amaro, he says, take far more creative risk. Empower Disney's creative teams, he says, to meaningfully scale up Disney's investment in original content creation around the world in hopes of finding more hit franchises, particularly in the kids and family categories. What do you make of that guidance from Mr. Greenfield?
Well, I think he's going to do that. I mean, especially when it comes to streaming on the streaming original content. If you think about the Shogun series, and again, they're really just copying Netflix here. You look at the success that Netflix has had with international productions. If you want to build your international distribution, you want to have international productions, and if you're lucky, they go worldwide.
Would you like to see tomorrow do a headline-making acquisition, Joe, a transformative acquisition like Iger did with Pixar?
Probably not on the table.
Why do you say that, Joe? Why?
Well, again, Disney's in the best position of any entertainment company not named Netflix. Okay, so to acquire something, what do they need? Okay, good. That would be my question.
Joe, you look at this stock. I mean, it's basically, you know this, of course, it's flat really over the last 10 years. I mean, you just pull up a chart. You've got to buy on this name. I guess what are the near to intermediate term catalysts, Joe, that you see that convinces you, yes, it's a buy here? Okay, starting with parks. They got their new attractions, new cruise ships. Everybody thinks about Disney as an entertainment company with the parks division, or they now call it experiences. It's really a parks company with an entertainment division. So start there. If you go to the entertainment, there's not too many changes in strategy here. Using that IP, that intellectual property that they have at a Pixar, at a Lucasfilm, at a Marvel. They're going to have that on the studio side. Basically, there are some issues here. You got to walk that fine line between your stars, the unions, and generative AI. Generative AI may just be too attractive not to use, but basically steady as she goes, and you'll build out blockbusters. Again, content is what's going to drive this company. Joe, great to have you on the show today. Thank you.
You're welcome.
Coming up, we'll bring you Micron's latest earnings. Stick with us. Time now for some earnings. Micron second quarter results are just hitting the wires. Let's get you those numbers. Q2 EPS, looking for that. There it is, $12.20. That's a beat. The estimate was $9. Q2 revenue also a beat, $23.86 billion versus estimate of $19.74 billion. Gross margins better than expected as well, 74.9%. The estimate was 69.1%. As to the forecast, Q3 adjusted EPS $18.75 to $19.55. The street had penciled in $11.29, and the Q3 revenue forecast also upbeat, between $32.75 to $34.25 billion. Consensus was $23.66 billion. Talking about all things AI, Micron says AI server demand continues to be strong. They do note AI and other server demand constrained by memory supply. Why do we care about Micron? Well, it's because it is the largest U.S. memory chip maker. Those chips go into all kinds of products, smartphones, PC, data centers. So it's a read on the health of those end markets. Area for investors here is HBM. That's high bandwidth memory. That's basically, simply puts, super high speed memory that sits on a data center GPU, carries better pricing and margins. This stock heading into this print, I mean, expectations were simply sky high. The stock was already up about 60% this year. It was up around 350% over the past 12 months. And that's just as Micron has really been benefiting from this powerful demand for its memory chips amid this great AI investment cycle. Even despite that run, analysts who cover this name, still big fans. About 90% of analysts who cover Micron still tell clients, even at these levels, this one's a buy. Time now for what to watch Thursday, March 19th. Going to start off here on the earnings front. Another big day of reports, including Accenture, Darden Restaurants, and Signet Jewelers. Alibaba also announcing results on Thursday. Big focus there for analysts is the pressure on profits tied to intensifying competition in China's e-commerce market. Companies ramping up spending to build out its quick commerce strategy. Investors are watching closely to see whether that strategy can drive meaningful revenue growth and help Alibaba compete with rivals. Turning to FedEx, that company's reporting third quarter earnings on Thursday, offering a real-time look at global trade and logistics demand. The company is navigating a complicated backdrop from higher costs to shifting trade dynamics and the impact of Middle East airspace disruptions following the war in Iran. Investors will be looking for signs of slowing volumes, but also whether pricing and higher margin services can offset those pressures. Moving over to housing, fresh data coming out on Thursday. Economist forecasting January new home sales to dip to an annualized rate of 722,000 compared to 745,000 in December. That comes alongside the weekly mortgage rate data from Freddie Mac. Affordability remains a burden on the housing market after sinking below 6%. The 30-year fixed rate has climbed back to 6.1% in the most recent reading. And finally, weekly initial jobless claims. Economists expecting claims to tick slightly higher to 215,000. That's a small move, but one investors are watching closely for any early signs of softening in the labor market. Stay tuned. Much more market domination over time. That's coming up next. Bob's Discount Furniture reporting solid revenue growth in its first earnings report since going public earlier this year. Yahoo Finance executive editor Brian Sozzi spoke to Bob's CEO about these results and more.
Look, the business is doing very well, very strong. You know, we reported a great year last year in the fourth quarter, and our sales and our profitability at record levels. We finished the year with a 7.7% comp for the year, and as you're showing on your screen, 2.8% comp sales for the fourth quarter. Very strong momentum, and we're excited that that continued into the first quarter. And as we fast forward to March, we're loving the momentum we see today.
Are you still seeing, has the traffic to your stores continued at a strong pace compared to when we talked on IPO day?
Yeah, it's stayed at about the same level. Look, there's not really any tailwinds going on in the furniture industry. It's been pretty flat for a while. So the growth that you're seeing from us is really intentional. So our plan is, of course, grow 10% new units every year, and we did that last year. In the first quarter, we've already opened 5 new stores, so we're on plan for 10% unit growth this year, as well as our comp growth. And the comp growth that we're seeing is intentional. We've leaned into driving conversion in our stores and on our website as an omni-channel player. And really what's happening is the consumer's still responding to this wonderful value proposition that we bring to the market.
Bill, I told you this when we last spoke. I'm a Bob shopper. I have all of your furniture in my house, all very true story. But when I went in there and bought all this furniture, I bought it because I thought and I felt that it was the lowest possible price. Now, you know what the industry calls the everyday low price model. Can you keep prices at these levels when with diesel costs, the cost to transport your goods has gone up so significantly?
Yeah, great question, Brian. And listen, our commitment to the consumer is that we will always be the best value in the market, this value without compromise commitment. And, you know, we've been around a long time and we've seen a lot of types of disruptions, right? Whether it's a pandemic or recessions or, you know, and now we've got this war and gas prices going up. You know, our merchants leaned in a year ago when the tariffs came out and made sure that we merchandise product at the right prices to maintain that commitment to the consumer to be, you know, 10% below our competitors' lowest advertised price. And we've been able to maintain that even across all of our price tiers, good, better, best. So as we sit here today, we're very excited about the values we have in the market. And as we like to say, value is always in vogue and the consumer's responding.
Bill, the U.S. war in Iran was not on a lot of CEOs' bingo cards this year. It also wasn't in their financial models, to be honest with you. I mean, how much is this rise in diesel costs and other costs because of this? How much more will this cost you? How much more will it impact the business of Bob's from, let's say, a transportation perspective?
Yeah. Well, listen, first off, you know, we're a big player. We have contracts with our ocean freight carriers that are, you know, a year long. We have contracts with our delivery partners. So we're relatively protected on that level. We've seen a few fuel surcharges come through already, but it's pretty muted. But we have a playbook to deal with this. You know, we've seen fuel increases in years past. We know how to deal with it and maintain our value proposition. So we're pretty confident as we sit here today, you know, what we can see ahead of us, that we'll be able to deal with the fuel charges as they come through. And if we need to make changes, we will. But as we sit here today, we're very confident in our ability to deal with these.
Bill, one thing that caught my attention in the earnings release, if I have this right, you focus, like some other retailers, on good, better, and best. And it looked like in the most recent quarter, you saw more consumers navigate to that good part of the equation. Is that the consumer trading down? Is that a sign of a more cautious shopper?
Well, actually, in recent months, we've seen a move into the better category, which we're very excited about. And we think that's in response to our merchants who last fall really leaned in and went back to Asia and our domestic suppliers to really beef up our better and best categories. So in Q1, we're seeing a step up into the better categories. And what's even more exciting is that a lot of it is consumers in the higher income demos. So the fastest growing income demo for us is the over $150,000 household income demo. And they're buying up into the better category, which is very exciting for us.
I see the same thing. I've heard the same thing from Walmart CFO, John DeVarani, calling out, you know, a trade down to them, or higher income shoppers coming to their stores. Where do you think you're gaining that market share? Is the new Bob shopper that former shopper that used to go to an Ethan Allen or a Lazy Boy, and they're like, well, hold on a second, these prices over there are just too damn high?
Well, as you know, our strategy is not to be a trendsetter, but a trend follower. So we follow trends in the industry. We bring out our version of these items that are already trending in other retailers, but we bring out our version with more features and benefits at a lower price. And the affluent consumers responding. In fact, all of the consumers are responding to it. And it's been a winning strategy for years for us, and especially in this last year as tariffs have affected so much of the industry. But we're definitely finding that the consumers attracted to our offerings in the better and best categories.
Stay tuned. Much more Yahoo Finance coming up next. Hello and welcome to Asking for a Trend. For more on Micron, we got Angelo Zeno now, CFRA Research Senior Vice President Equity Analyst. All right, Angelo, Micron reports. Give us the instant analysis. What'd you make of the print?
Hey, Josh. So I'd say overall the print was really good. You kind of look at the quarter here for the February quarter. I think close to 24 billion in terms of revenue. They crushed it by nearly 4 billion in terms of the expectations, and then clearly that trickled down into the earnings as well. I think the guidance was even more phenomenal. Essentially guiding, I think, about 33 billion or so for the May quarter, about 10 billion or so above what we had expected. But I think maybe the most important figure was the gross margin number for the May quarter. They guided to 81%. I think we were looking for about 71%. I think that
the reason you're seeing a bit of a pushback or sell-off here after hours might be the fact that, hey, listen, you're essentially now buying this stock at peak margins or near peak margins, because it's unlikely that these type of margins are going to be sustained here in the foreseeable future. But that doesn't necessarily mean that the fundamentals have to stop improving.
What do you say, Angelo? Why do you say you may be at peak margins here? What are the puts and takes there?
Well, as far as gross margins, I mean, 81% margins is just, it just seems like it's unsustainable, right? I mean, you look at prior peak cycles in terms of the memory industry for a company like Micron, we were talking maybe something along the lines of 50% margins. Now, clearly this time is different in the sense that the crux of the issue is what's going on the data center side, what's happening with high bandwidth memory. High bandwidth memory is by far the most complex product that's ever been made for the memory industry. It does command higher margins. It's got, it's just a favorable mix overall as Micron continues to shift towards that side of things. But that being said, what is probably going to happen here is, and what Micron did state is, they're going to have to significantly increase CapEx spend, probably at a run rate faster than revenue at some point in time, potentially going into 2027.
This 2026 CapEx number here, they're seeing the bogey, they say, is above 25 billion. Consensus was more like 22 billion.
Yeah, and to be honest with you, that's not that bad. 25 is perfectly fine when you actually look at the revenue, how high the revenue number went up, right? So, but more importantly, I think is going to be what is the visibility? What does 2027 look like? It's not something that they're probably going to provide on this call. They did say it's going to be significantly higher than what it is in the current run rate, but that's to be expected. You'd also expect revenue to be significantly higher. But that said, hey, listen, I think the street is well aware of that. I mean, this is now, when you look at the trajectory here for the May quarter, you're looking at, if you're talking $19 in earnings per share, that's nearly an $80 run rate. That's essentially a 5-6 PE based on where the stock is trading right now. So typically you don't want to buy at these low multiples. But again, if this is something that can last here for several years, and you look at the free cash flow potential of this company and the earnings trajectory here, it does still look attractively valued.
Angelo, it's interesting because historically investors, and you know this because you've been covering the space for so long, but when you thought of like a memory chip name like Micron, Angelo, you thought of them as sort of this cyclical, commoditized business, right? And there was a rhythm to it, there was a pattern to it. You think that's still true, or I don't know, are we entering a new era maybe for this space, Angelo? Has something structurally changed?
It has structurally changed, or at least we think it has. Now, the question is, it's structurally changed, but at some point in time, we also think it reverts to some cyclical patterns or behavior. To what extent that exactly looks like at some point in the future, who knows? But at this point in time, I think this goes on for a couple of more years. I think really what the key point here for Micron is listen, again, the free cash flow potential goes up significantly. They're essentially going to be a company, if they play this right, they're going to be able to be debt-free over the next, over the next couple of years. They're going to have a huge net cash position. They just increased their dividend by 30% here today. This is a fundamentally different type of company that's going to come out of this thing, a much stronger company in nature, where in prior cycles, you were talking about losses, you were talking about negative margins, you were talking about the need to have to raise debt just to kind of get through some cycles, right? That's not something that you no longer have to worry about. And again, I think this is an interesting time because you've got to try to decipher what that mid-cycle, earnings trajectory really looks like, and then put some sort of multiple on it. But it's just extremely difficult to do at this point in time because of the secular tailwinds that you're going to see here over the next couple of years.
Angelo, in terms of the competition, so, Micron's dealing with Samsung, SK Hynix. How do you think about, Angelo, who has the competitive sort of technology edge here? Is there one of those names that you think, yes, they have the technology leader here?
So, SK was really they were kind of the front runner and leader here as far as, the shift to high bandwidth memory and, their presence within NVIDIA. And, you kind of had Micron also, with high bandwidth memory 3 and Blackwell last year really kind of start to emerge. And again, they are going to be in this Rubin cycle Samsung was a little bit of a laggard, but they're now coming on fairly strong as well. So I'd say all three players at this point in time have the right capabilities and products to really be successful as we continue to emerge in this high bandwidth kind of upswing. So again, it's a place where we do like where Micron's at, and I'd also say as far as mixed percentage, and I think this is important, about 80% of their revenue right now is tied to DRAM, so they are kind of heavily weighted towards that theme specifically.
Angelo, after the run-up this name has had, how would you characterize valuation?
Yeah, I mean, again, valuation is cheap for this company, right? I mean, we're talking, again, if you're looking at just the run rate here for the May quarter, it would you almost back out, an earnings figure about 6 times or so. Again, but when you kind of look at the long-term trajectory of this company, when you should be buying, selling, you usually do sell when the valuation is cheap, and you buy when the during the dark days. But again, if this is something that continues here for the next couple of years, and it's it's a situation where the fundamentals will actually continue to improve, where you get positive free cash flow and what have you, I do think this becomes a really interesting time, and the market's already basically telling you, hey, listen, we'll give you this deep discount because you are paying at these higher, let's call it towards the peak margin trajectory. So that's where we're looking at valuation right now. How that kind of works itself out here over the next couple of quarters and years remains to be seen. But at the very least, it is an attractively valued stock.
Angelo, kind of final question. Listen, you got to buy on the name. But when clients ask you, okay, what are the big risks, though, I need to think about that should be on my radar with Micron, what do you say?
The biggest risk is clearly going to be, the supply-demand landscape, and, when do we kind of hit that peak level? I'd say right now, for me, the unknown for Micron is what is the CapEx spend look like as we kind of go into the out years, specifically calendar 27. Again, it's not something we're probably going to get an answer on this call, but I would say, if you get a significantly higher than expected CapEx number from Micron, that does have implications in terms of how we look at the free cash flow trajectory of the rest of this upcycle, and that could have also an impact of how you value this stock. So I'd say that right now is the biggest risk, is what does that free cash flow trajectory look like in some of these out years?
Angelo, as always, great to have you on the show. Thank you, sir.
All right, thanks for having me.
Well, Chipotle is launching a new sauce for a limited time starting tomorrow. The fresh cilantro lime sauce, created by culinary analyst Danny Boizo, who started actually as a Chipotle crew member back in 2019. Joining me now to discuss this, we got new menu innovation is Danny Boizo, as well as Chipotle's Senior VP of Culinary, Neville Pantaki, and Yahoo Finance Senior Reporter, Brooke DePalma. Welcome all. Danny, I'll start with you, because I did read you started as a Chipotle crew member. So you're on the line there, Danny, and now you created this new sauce that's rolling out nationwide. What was that like, Danny, when you found out your sauce was going to be hitting menus across the country?
Oh, it was amazing. It was a dream. Today's my birthday, so it's definitely the best birthday present I could have gotten.
Happy birthday, Danny.
Danny, you were on the line there, so I'm just curious, was part of your inspiration from this just kind of what you watched and heard and saw on the line from customers?
I walked into a Chipotle store today, and I love hearing the buzz. They're excited. They're asking crew members, they're interacting, what's in this sauce? Can we get more? Are there bigger sizes available? What took so long?
Neville, from what your standpoint is, what operationally do you have to do to add sauces to the line? We know that you guys launched chimichurri and adobo ranch. Now this is a new sauce coming to the line. How difficult is this from an operational standpoint to make happen, especially for a limited time?
Yeah, that's a great question, Brooke. Ultimately, the collaborative effort by the operational teams to validate this was Herculean. And Chipotle's footprint, as you can see when you walk down the line, is very fixed, right? We can't just add more cold space or hot space. So the teams wanted to make sure that this was available front and center to guests as they walk through the front serve line. Obviously, we do things on a digital scale as well, and digitally this is also available. But it created an opportunity for us to think a little different. Chimichurri, adobo ranch, those were available pre-portioned. And we really wanted to make sure that guests were able to enjoy this beautiful, creamy sauce in any way they wanted, whether it's in a burrito, in a bowl, in a taco. So as you're walking down your line, getting exactly what you want, the way you want it, whenever, whatever time of day, you can add it into your bowl or your burrito, just like queso or guacamole, or you can get it on the side in a small version of the side cup, as well as a larger cup that we've showcased here for you today.
Yeah, Neville, we also have these large cups, and they're quite big. I guess from terms of a price point, what are we looking at here? Because I'll be honest, sometimes I'm like, do I want the extra guac? Do I want to pay the extra money? So what's the price point here? And what sort of response have you seen so far?
Yeah, look, the response has been phenomenal. We wanted to make sure this was accessible for folks to share in the larger cup as well as just in your bowl, as I mentioned. So we're starting at about $1 and going to about, I think it was $3.50 or $4 for the larger cup. Very accessible, great for sharing. And at the same time, one of the things we've heard is I can't get enough sauce. 60% of consumers nowadays are wanting to really personalize things with flavors. And Danny has done such a great job, coming from the field and hearing what guests are saying, being from the crew, understanding how complex our real food proposition is, where we're taking fresh chopped cilantro, we're adding it to, our blenders, and we're fresh daily making the sauce with a touch of roasted jalapenos, lime juice, and some Mexican spices, right? So bringing that culinary craft to every restaurant to deliver a creamy, personalized way to enjoy your bowl in unlimited permutations and options is truly something we're very excited about.
Danny, what does this sauce pair the best with, in your opinion?
Oh, what does it pair the best with? I've tried it with everything, but my favorite is using it as a salad dressing. That's my little hack. I think cilantro lime sauce as a salad dressing just brings a whole new dimension to your salad. It's bright, it's flavorful, it's authentic, just a touch of heat.
Yeah, Brooke's about
to dive in.
She's going to dive in. Give us her opinion. Neville, you touched on this kind of broader trend, which I think is interesting. Apparently, Neville, from what I'm reading, Americans love their sauces, right? And apparently, it's a kind of a trend that's very pronounced. I guess millennials, Gen Z love their sauces. What explains that, Neville, do you think? What's going on there culturally?
Yeah, look, I think there's a level of discovery and personalization and control. And I think what we're hearing is, people are on their screens, they're on their devices, they're in platforms and spaces that they really want to personalize for themselves. And I believe that sauces allow them to experience their default bowl or brand in just a whole different way. And, for us, delivering that, in a turnkey way, which is equitable to us, right? Fresh ingredients, real culinary craft, made daily by our crew members, and we lean into that, and allows you to drizzle this on a high protein taco, which is about $3.50 from an entry level price point, or a double high protein menu of a burrito or bowl, which has incredible macros. And that goes back to, again, personalization, right? Folks are looking to eat food in a way that's not just functional, but it's also flavor forward. And whether you're on a health and wellness trend, whether it's convenience, whether it's a snack, these sauces and curating the digital channels and the in-restaurant channels to do that is exceptional.
And Neville, that kind of speaks to what I'm eating this sauce with, and that's the new protein cup that you guys launched just recently ago. I have to say it's good. It's like a sweet but like savory.
Sweet and savory.
Honestly, 10 out of 10. I could see this being a salad dressing. So I will dive into that next, guys. I'm pretty hungry. But Neville, I've covered Chipotle in terms of just the career pipeline that you guys have. I'm sure someone listening to this segment, maybe they're working on the line right now at one of your locations, and they say, I have an idea for a dip. What would be your advice to them?
Yeah, we truly believe that great ideas come from everywhere, and we're always listening to our guests. We're always actively listening to our crew members and our restaurateurs and operators. And look, whether you're on the team here or in the field, please continue to send us feedback. Please let us know through our social media websites and channels. Our team is always listening. And look, when we talk about trends, we talk about what's happening, right? You talk about flavor discovery, spicy, bold, craveable flavors. We just launched chicken al pastor, and it is a beautiful flavor profile. You can get it in a protein cup, and it pairs so well with this sauce. So, feedback whether it's portion size, whether it's how you want to interact with the food, or even flavors. We get a lot of it today, but we welcome more of it, absolutely.
Neville, I'll have to ask you offline how many calories this entire cup is, because I think I might just eat it all, Josh. I'm in trouble.
No judgment. No judgment on this set. No.
But in terms of how long will this be on the menu, and also how far ahead are you planning this? Are we already going to see a dip in the fall?
Yeah, so we are very excited because this launches tomorrow, March 19th nationally. We're going to continue to accelerate and pour more gas on our innovation in a very Chipotle format, right? So we want to make it relevant to the brand, relevant to the guests, but also it's got to be executable in our restaurant. So you're going to see more sauces. You're going to see us do more with flavors. You've obviously seen some protein innovation over the last couple of years. You're going to see that again coming to light. We have an incredible slate of products that our marketing team and our brand team has worked on, and we're so excited that you will get to experience these in the next few months and so on to come. So please do stay tuned.
Neville, how mindful are you of the cost of ingredients right now, with so much in the background going on with not only tariffs, but also now higher fuel costs? How much of that is going into this as you do plan that pipeline out over the course of the next year?
It's part of our stage gate process. We are very, very cognizant of the impact and everything that we do has on the supply of our real food and our real ingredients. It's not easily available to buy the best quality organic or regenerative products or ingredients that meet our animal welfare standards. Even this dairy that's in here, the sour cream base, has high standards. So the supply, making sure that any geopolitical or any other challenges that we're having from an inflation standpoint, what are our suppliers telling us? What are our teams telling us in the supply chain team? But at the end of the day, it's a balancing act, right? We want to make sure that we deliver craveable products that are consistently executable, and we want to make sure that the guests comes in and tries them and can actually fit them into their Chipotle order and their lifestyle in whatever format they want to include it in. So we're very mindful. I would say that we're not extremely more cautious right now. It's always been part of Chipotle's innovation and stage gate process.
Danny, I'm just curious. Final question. You sort of grew up at Chipotle professionally, Danny. What does the company do right in terms of kind of developing talent?
I think one thing that Chipotle does right is people development. There are so many opportunities to learn. There's education programs that my siblings have also gone ahead and taken advantage of, and that's gotten them through school. So Chipotle has always inspired me to stay curious, ask the whys and the hows, and in turn, they really invest in their people development.
Danny, Neville, great to have both of you on the show today. Danny, happy birthday. Thank you.
Thank you.
Coming up,
Thanks,
we
guys.
talk the business of March Madness. That's coming up next. Don't go anywhere. March Madness is here, and the business behind college basketball is changing fast. NIL spending is surging and reshaping the competitive balance. For more, we're bringing in now Ross Dellinger, Yahoo Sports reporter. Ross, it's good to see you. So let's dig into this number. So college basketball NIL spending, Ross, surges to about $933 million for the 25-26 season. How should I think about that number, Ross? I mean, is that good for the game? Is it a positive? Is it more of a mixed bag? Walk me through it.
Yeah, well, it tells you the players are getting money now, right? For so long, the players got a scholarship, obviously, tuition and books and all that good stuff, but now they're actually getting some compensation from the biggest event that the NCAA puts on, right? The NCAA basketball tournament is worth over $1 billion for the NCAA and all the conferences and schools. And so finally, right, we're seeing the players through NIL, through revenue share from their schools, getting a piece of that. So to break that number down, because that's obviously a huge number that covers all of probably Division I schools. There's 350 Division I basketball playing schools. So it covers a lot of schools. I would guess that at the power conference level, right, the Big 12, the Big 10, the SEC, the ACC, and throw in the Big East, for basketball, your average is, as far as the roster and what it's worth, is probably in between $6 and $12 million. So that gives you kind of an idea of what a roster is maybe worth at the highest level of college basketball.
Ross, you also flag here new money units coming to the Final Four teams this year. What is a money unit, Ross, and why does it matter?
Yeah, it gets a little complicated, but every win that a team earns in the tournament, that team gets a certain amount of money, a unit it's called, per win. This year the units are worth $350,000, but they're really worth more than that because the payments are made in 6 installments for 6 years of $350,000. So a unit is well over $1 million. And now that money goes directly to the conference, and it sort of gets distributed across each league. But some leagues have it where you kind of eat what you kill sort of thing. In the school, the money goes directly to the school. For these smaller conferences, that's big money. Right? I mean, over $1 million per win is big money. Now, the Final Four, right, which you asked about the Final Four distribution. Before this year, the teams that advanced to the Final Four, all the unit payments stopped at that point. So you couldn't, if you won in the Final Four and then you won the national championship, those are 2 units, you didn't get those payments, right? They just did not, they stopped at the Final Four, basically. Now we'll see those payments happen. So teams all the way through the championship game, as they win, they'll earn these individual units, which again are 350,000 times 6, so well over $1 million.
What are the changes to the portal opening we didn't know about, Ross?
Yeah, the portal's moving, on the move. I think last year the portal opened around now, actually, and was open through the NCAA basketball tournament, which you can imagine wasn't great for recruitment and signing of players when you have 65 plus teams still playing. So the portal opens the day of the national championship game. I believe it's April 7th is when the portal actually opens for the year, and it's 2 weeks, and so you have a 2-week portal there. And that number you mentioned, 900 million or so for NIL, that number will probably be 50% higher this time around, at least 50% higher this time around. So basketball rosters, although many people think that basketball rosters are going to drop because of the new salary sort of cap that's in college athletics, I don't think that's going to happen, right? I don't think players and agents are going to let their payments actually drop, their salaries drop. So expect rosters to be even higher than what they were this past year, which again were probably $8, $10, $12, $14 million in value this year.
Finally, Ross, WNBA gets a new contract. What do you make of it?
Yeah, huge contract for the WNBA. I saw some of the numbers reported. I think the new salary cap is $7 million, which is up from $1.5 million last year. So it's a huge jump. And all of the numbers sort of increased 5 times, right? The average salary, I think, of a WNBA player now will be $600,000. It was $120,000 last year. So I saw a lot of comments from the players, the board, though it's made up of players, after the meetings, and a lot of them discussed about how this is sort of player empowerment. This is the player empowerment era, and obviously in some of the salaries you can see going up significantly. That's very true.
Ross, great to have you on the show today. Thanks for your time.
Yeah, thanks for having me.
If you want to shoot your shot at a winning March Madness bracket, check out Yahoo Fantasy's Bracket Mayhem. Just be sure to make your picks by Thursday, March 19th. That's going to do it for today's show. Thanks for watching.